we've got a lot to talk about. It's a pretty action-packed week. Mike, I'm so confident it's going to be 75 basis points that if it's 100 basis points, I'm going to eat grass on camera for the pleasure of our viewers. Yeah, it's kind of like the Super Bowl for central banks.
This episode is brought to you by Circle, the issuer of USDC, one of the most trusted stablecoins in the digital asset industry. You'll be hearing all about them later in the show. All right, everyone, we are back for another episode of Forward Marginal Guidance. I'm joined, as you know by that name, by my colleague, Jack Farley. Jack, welcome back, buddy.
We've got a lot to talk about. It's a pretty action-packed week.
It certainly is. Some are calling it even Central Bank Mega Week.
Yes. So let's see. I think it was Nick Glinsman who wrote that over 500 basis points of hikes are going to happen. Let's see. So tomorrow, Sweden will kick us off. The good old Bank of Sweden. We love that. They're going to hike by 75 basis points. On Wednesday, the Federal Reserve will have their FOMC meeting. Powell will go out. It'll be a fun day. That's expected to be 75 basis points. Currently, the market's assigning like an 80% weighting to 75 basis points and a 20% weighting to 100 basis points. I'm in the camp, Mike. I'm so confident it's going to be 75 basis points that if it's 100 basis points, I'm going to eat grass on camera for the pleasure of our viewers. Brazil, the Bank of Brazil will not hike interest rates on Wednesday. They're already at 13.75. They're kind of like the early adopters, Then Bank of England, I think will also do 75, or was it 50 on Thursday? Swiss National Bank. So yeah, it's kind of like the Super Bowl for central banks.
Certainly. And for those of you who are following along on video here, we've actually got Bloomberg put together a helpful little map actually of where these rate decisions are being made. And you can see they break it out Tuesday, Wednesday, Thursday, and Friday. This is obviously going to be airing on Wednesday. But I think we can still talk about, Jack, what the implications are. Basically, there's a unanimous consensus, right? The central banks are raising. Maybe on the lower end, we've got Brazil, and on the higher end, we've got the United States. But basically, the consensus here is that banks are going to be raising all around, right? And I think the question that I certainly have is, with all of these 500 collective basis points of raises, where are economies at, right? Because you and I, we had this conference at DAS last week. There was some great crypto content. There was some really great macro content. And kind of the consensus view among our macro panelists was that we've actually already started to see disinflationary, if not outright deflationary trends start to pop up, at least in the US-based economy. So I guess my question to you is, what's your take on all of these hikes that are about to be priced in when we've already seen economic data starting to turn?
Great question. I think for the US and Europe, inflation is so high that these hikes are, at least for now, in my, what do I know, opinion, warranted. I will say that in preparation for this talk, just reading some of the more recent economic literature, like from the IMF, from the World Bank, the growth forecasts look extremely, extremely poor. I think actually economic growth in the UK in 2023 is going to be negative, which is truly stunning. And I believe that is a nominal figure. So you have negative nominal growth. On top of that, presumably you're going to have some form of inflation. Is it going to be the 10% we're seeing now? Perhaps it's going to be lower. It's not looking great. One
really interesting point that Juliet de Klerk made, and I know we're going to get into this later. She gave I got to give Grant Williams a plug. Did a fantastic interview with Juliet, who actually makes the very controversial case for a soft landing. Was that in the same way that forward guidance is basically being used as a tool, and the Fed wasn't saying, hey, we're going to start raising rates, and they were way behind the curve. We're now taking Powell and central banks at their word that there's going to be continued hawkishness, right? So I think there's pretty good. You could pretty safely assume, right, that if you don't take the forward guidance and everything that the Fed says exactly at their word, 9 months ago, you shouldn't necessarily be weighing that heavily into it now. I don't know what you think about that take.
That's right. That one case for a soft landing is that the Federal Reserve pivots sooner than is currently priced in the market. I should say the 2-year Treasury yield is now at an extremely high point relative to what we are used to, of like 3.95%. I believe the terminal Fed funds rate, so how high the market thinks is the highest point the Fed will go, is just shy of 3.5%, I think in April of 2023. and it's forecasted to stay there higher for longer. Although you do see about 50 basis points of cuts out in the way until 24, like on a probability sort of weighted distribution. So that's one case for the soft landing. The Fed pivots sooner than is priced into the market. And I would say that is not my base case. I think on Wednesday, the Fed will hike by 75 basis points, which is, quote, less than the market's expecting, because it's expecting a 20% chance of 100 basis points. And I can explain why in a bit. I actually, by the way, thanks. Yeah, fantastic interview with Juliet de Klerk. Thanks for recommending it. I think her base case for a soft landing is that inflation will fall naturally or by itself, and that growth will be sufficiently robust so that the hikes that are priced into the forward interest rate curve are will be realized, and in other words, the economy can take it. So this is a chart from the World Bank report entitled "Is a Global Recession Imminent?" Which came out very recently, and you can see that in the red line is economists' expectations of inflation, global inflation, over the course of this year, and the blue line is economists' forecast of growth. So economists' forecast of growth has flatlined, while economists' expectations of inflation has exploded higher. This is pretty much a textbook definition of stagflation. So I want to get into Juliet de Klerk's thinking, but let me just quickly explain why I think 75 basis points is coming. Is that the Federal Reserve, Fed Chair Jay Powell in particular, is very reticent to shock the markets. When he likes to, when he shocks the market, and shocking the market is necessary, he likes to let the market know that they will be shocked. And we have up until this point not had that piece. And Nick Timmeros, who has a very good sourcing, he has not come out with an article saying that 100 basis points.
That's a very funny way of phrasing it. He's got very good sourcing.
He has very good sourcing. Yes, and I think that 75 basis points is the base case of the market, 70%, 80%. And if Fed wanted the market to change that, they would not want to have the market surprised, and they would let it be known prior that 100 basis points is coming. So we haven't had that. So yeah, and I think don't mistake what I'm about to say for like medium term or long term bullishness on anything, but I think we could be set up for a sort of rally, just because what will be priced in a 20% chance of a full point cut won't happen. Now, a lot of people are saying that, so that might be consensus. And as Mike Green and Harley Bassman remind us, sort of interest rate futures, bonds, commodities, they don't really tell us anything. Like the bond market does not exist to give you a macro framework that you can make so that you can make forecasts. It really is a condition of people basing a hedging. So in other words, people could be like could have a lot of risk assets, stocks, crypto, commodities, everything, and really anything that's not like money, anything that's denominated in money, and anything that's not money. And they might want to protect against that, so they would buy Fed funds futures to protect against a 100 basis point rally. In other words, so yeah, that's sort of my thinking, and that's why I will eat grass on camera if it is a 100 basis point hike.
Just while we're on the position of taking controversial opinions on this podcast, I think you could actually make a pretty good case that the Fed kind of deserves a little bit of a pat on the back, because if you were viewing this, we spoke to Danielle on the last this last week's interview, and we talked about the Fed trying to get some of its monetary toolkit back, right? And I think the Fed has actually done a pretty good job of getting that toolkit back, in that they've raised rates, right? The market now fully expects, right, the terminal rate or whatever it is, like 4% or something like that. I actually thought Fed fund futures were above 4.5% or something in April of this coming year. But whatever it is, we're hovering around that 4% mark, which, even 6 months ago was unthinkable, right? And at the same time, they've hiked rates this aggressively. The S&P is only 20 some odd percent off the highs, right? Unemployment is still basically at, if not historic lows, certainly generational lows, right? At sub 4%. they've kind of got their wiggle room, right? I think they've done a pretty good job of actually raising rates pretty quickly while maintaining some wiggle room. While there certainly is room on the but both the price stability side of things and the unemployment side of things. So I know people hate giving the Fed any sort of credit whatsoever, but you know they haven't told. I mean, they've certainly reacted too late in dealing
Yeah.
with inflation, but they're not sitting. They're not. They could be at a worse. They could be at a worse position. I think I would say.
Yeah, it's my case that yes, the Federal Reserve was way behind the curve in 2021, and they essentially tied their hands with flexible average inflation targeting in 2020, which really prevented their ability to act in an expeditious manner. But I would say, like, if you sort of say the Big Bang is January 1st, and the world starts on January 1st, and sort of Jay Powell and the Fed inherits its prior mistakes, I would give the Federal Reserve relatively high marks. Folks can think I'm biased because I have my podcast is named after a central bank technique. It is what it is. What else was I going to say? Oh yeah, I actually did an interview that aired today where Ted Oakley, who's very bearish on stocks, and he said that he's took quite a harsh view of the Federal Reserve. And I wanted to, be diplomatic, be a classic journalist, and I'd be like, okay, Ted, but would you say that they've done a better job this year? Like, would you give them that? And Ted was like, no.
Wow, sparing notes. But yeah, I mean, it's certainly very easy to and the sort of criticism of the Fed is they got kind of whipsawed both ways on this, right? Is that they were correct but ultimately early to transitory narrative, right? So they kept their foot on the gas for far too long. They were looking in the rearview mirror then, and now they're going to get whipsawed in the other direction where they're continuing to tighten and they're looking at these very lagging indicators of both CPI and the unemployment rate, which again are very, very lagging indicators, and they're going to keep tightening, keep raising rates, even though the economic momentum has already turned in the U.S. And I think I guess what I think about that is ultimately if what the Fed has to do is get ahead of these sorts of things, then we've got a system that's set up to fail, right? Like the Fed is this big monolithic institution that can't take risk, right? They're not going to be out ahead of the risk to kind of anticipate where the market is going. I just if that's what we need is a forward looking Fed, then yeah, we're kind of setting ourselves up to fail, I suppose. But
Yeah, just to explain what you mean for the audience. So
mm,
there are widely embraced tools that macro investors and market observers look at that have a actually extremely good track record of predicting economic growth, like inverted yield curves, or looking at PMIs. Like PMIs will tell
mm,
you what the unemployment rate will be, 3, 6, 12 months from now. So the Federal Reserve, by looking at and weighting primarily the unemployment rate, which is the last thing to move, they will almost by definition be behind the curve. But yeah, now let's go into the chart that you made based on Juliet's work.
it's very hard because basically everyone was so wrong on this for such a long period of time that that yeah, I think you take all of these surveys with a pretty big grain of salt. But I think I kind of want to start just voicing because it's just so the pitch of doom and gloom recently has been so high that I do think there are more positive stories out there, and not all economic data that we see, not all survey data that we see supports this idea that there's some sort of Great Depression, market implosion right around the corner. And I think the more you see inflation expectations come down, the more you see commodity prices go down. And honestly, God willing, if we had, some sort of ceasefire or
Mm-hmm.
ceasing with the geopolitical conflict over in Europe, I think you could start to see the narrative turn pretty quickly.
Yeah, so you said you got to take these surveys with a grain of salt. For folks who are listening,
Mm-hmm.
we see the University of Michigan 5 to 10 year inflation expectations dip down slightly, and we're seeing the 1
Mm-hmm.
year dip down slightly as well. I take these with a huge grain of salt.
Yeah.
I feel like asking, sort of man on the street, woman on the street, calling them up and asking them, "Hey, Mike, what do you think inflation will be over the next 5 to 10 years?" That the answer that you're going to get is like barely more accurate than if you ask someone on the street, what do you think the price of Bitcoin will be in 2029? It's like it's so
Mm-hmm.
unknowable, and also it's shaped by people's perceptions. Like I'll give you, if you asked someone a year ago, on the street, what do you think the price of Bitcoin would be? They would probably, they'd say $500,000, and now they'd say $2,000 on the street. It's sentiment varies so widely, and it's so oriented on past conditions. I mean, we were talking about how the Federal Reserve is behind the curve because they're looking at primarily the unemployment rate, the labor market. I mean, look at this chart. On the left, we've got 5 to 10 year University of Michigan inflation expectations. It peaked in 2008 when inflation was at its local high in maybe early summer of 2008. But then obviously you had a worldwide extreme recession that actually caused deflation. And then in 2009, what did they forecast? They forecasted low inflation. And yeah, I first of all, I don't have a ton of faith in economists' ability to forecast this, but the average person, I think their ability to forecast inflation, like my ability to forecast inflation, is very weak. And also, okay, Jack, you don't like the surveys. But what about the TIPS yields, the inflation break evens that are implied by the Treasury inflation protected security rates? I don't really take those. I take those with a grain of salt as well, because the Federal Reserve owns like a quarter of them, and they're used as hedging tools.
Just under 30%.
Yeah, exactly. They're used as hedging tools by investors. So that's my rant.
Here's one thing that maybe the inflation expectations is a little bit different than what is the price of Bitcoin going to be, because I agree that the average person on the street doesn't have great predictive power to answer either one of those questions. But inflation is in some senses a psychological phenomenon, right? It is a collective belief that prices are going to be higher tomorrow than they are today. So what I think it would be much more concerning if we were looking at the inverse of these two charts, and generally the population believed that inflation was going to be higher 5 to 10 years from now than it is 1 year from now, because that would tell me that this idea of inflation being psychologically baked into the population is just it's deeper, right? Whereas these two charts taken together say, yeah, people understand that inflation is going on today, but in general, they think it's going to be less 5 to 10 years from now and more 1 year from now, which is kind of what you'd like to see, right? So people generally, even though people aren't happy about it, they're viewing it as something of a temporary phenomenon, which probably just means it's less baked in.
Yeah, I think these things matters for two things. On the longer term, because inflationary psychology can become embedded. And then on the second term, because the Federal Reserve pays a lot of attention to that, because they believe in this sort of embedded inflationary psychology theory.
Here's the other thing that we know. I want to skip a little bit ahead here and just talk about Treasury market depth, because we know that the Federal Reserve pays an enormous amount of attention, right, to, let's call it, normally functioning of the Treasury market. That was certainly what they cited back in 2020, when, again, it wasn't, the Fed didn't jump into markets and say, hey, we're really concerned about what the S&P is doing or the NASDAQ are doing or asset prices writ large. They were concerned about liquidity in the Treasury market. So, again, what we're seeing here, and I think this is a chart that comes to us from Nick Glinsman, but that
actually comes from Joseph Wang. It comes from Joseph Wang, Fed Guy 12.
Okay, great. Then why don't you just, because you sent this chart over, Jack, why don't you just walk us through what we're looking at here, why it's important?
Okay, so I've never traded, $100 million of Treasury futures or cash bonds in my life, but this essentially measures Treasury market depth, and higher on the chart means more liquidity, means, you want to buy or sell a lot of bonds. It's going to be easier for you to do it. The brokers are going to pick up your call. They're going to charge you a lower spread because they have more ample warehousing of these securities on their books. Oh, Mike, you want to sell it? I got you. I know a buyer. Let's make a deal. Boom, bang, boom. That's the top. That's the high on the chart. Low on the chart means that it is tough to sell. And it's the opposite. You get charged a higher spread. The broker, you're going to have to wait on the phone call, stuff like that. And the apogee of this was in March of 2020, when we had this worldwide recession. Everything was crashing. Every risk asset was crashing hard. When growth falls off a cliff, inflation expectations falls off a cliff, risk assets plummet. What do you expect to do well? 10-year Treasury notes, 30-year Treasury bonds. But they weren't. They actually crashed as well because the market essentially treated them like they were a risk asset. And some theorize that is what really drove the Federal Reserve to do not just QE, but to do QE on steroids. QE on steroids. Is that going to break? This is tough because in March of 2020, the market wasn't functioning because treasuries, securities were selling off when they should have been rallying, according to all economic logic. But now the sell-off that we see can be justified by economic fundamentals. So I don't really know what a collapse in the treasury market is. I don't really have a quantitative framework for measuring that. I do know that we are just past a 3-year anniversary of the repo crisis in 2019, which caused repo rates to spike extremely high. The Federal Reserve supposedly they have a facility, the repo facility. I think it does $500 billion. That's the maximum that it can do. And Joseph Wang says if they need to do more, they'll just change it and do more, where they can essentially contain that market. So when people talk about something breaking, um, it's tough to imagine what that would be other than the economy or very vanilla assets, like let's say high yield credit or something like that. But in terms of the plumbing, I don't I don't think that we are at the point yet where things are quote breaking.
No, but I think this is just the reason why I think it's important to look at this chart is it's just one more thing that we know that the Fed pays a lot of attention to, right, when they're measuring stress. So, it again, we've said a lot on this show, but people tend to focus on the stock market, right, as something that's kind of be all end all important, right, because people tend to own a lot of stocks. But the treasury market is something that's extremely important to the Fed when they're trying to consider, have we taken the current trajectory of our policies of hiking too far, right? And right now it looks like, we're nearing lows, right, in terms of liquidity, but it also doesn't seem like the rate of change is aggressively steep either. So, when you saw that again, the apogee, great vocab word there, back in March 2020, there was an enormously steep rate of change, and it seems like it's more of a gradual, slow walk down, and rate of change is, I think, extremely important when it comes to these sorts of things. So,
Yeah.
I think it's just one more data point for how much stress the Fed feels like they're under, and I would wager I don't think Jerome Powell is looking out there into the world and saying the world is breaking right now because of our policies. I think largely they've pretty much swallowed, these Federal Reserve price hikes, and nothing appears. Things are straining, but it doesn't seem like anything's breaking at the current time.
Yes, I think that the stress that you've seen in industries has been quite localized to interest rate sensitive sectors. So, when interest rates are at zero and money is free, everyone wants to, all the companies want to borrow, all the investors want to buy. Let's hire all these people straight out of school. We'll do, $100 billion in volumes. Oh, by the way, the investors also want to buy SPACs. They want to buy everything. That is definitely slowing down. Likewise, the same for housing. I'm much, I don't know exactly how I feel about the housing market in terms of housing prices, but in terms of the mortgage industry, that is, the originations are down over 50%. It depends on how you measure it. So I think a lot of the pain has been localized to like extremely hyper focused sectors, but we haven't seen that pain in the labor market. But again, I get looking at some of these doomsday charts, I get pretty worried about the economy. So I think if you guys had to ask me, what do you think will something that breaks? I think it would have to be the economy. And by the way, for something to break to matter, it has to be something that the Federal Reserve cares about, right? Like, oh, the SPAC market is underwater, the SPAC market is broken. The Federal Reserve does not care about that. That's not within its mandate. Yeah, and I just want to comment on how sort of doomsday grim the language is coming out of the World Bank. Again, the name of the report is a global recession imminent? And this is just a quote. The specter of a global recession has increasingly haunted policymakers as they observe the rapid deterioration of growth prospects amid rising inflation. It's very, like a horror novel or like a sort of a death metal lyric, like using words like haunted. These are economists who typically are quite dry in the language that they use. So I think that the economics profession generally is seriously going to be worried about growth a lot more, and they already are, than they were 3 months ago. Yes, I know 3 months ago, if you said that we weren't already in a recession, everyone on Twitter called you an idiot, and that sort of, the sort of people less in the mainstream economics profession sort of front ran economists and were right. But I think that growth scares will be serious going forward.
I speak to a lot of companies in both crypto and traditional finance, and as it turns out, they share a common problem. They need a one-stop shop for treasury management and fast international payments around the globe. Circle's USDC is one of the most trusted and widely used stablecoins in the industry. At the time of this recording, USDC has 50 billion in circulation, 1.5 million users worldwide, and is settling more than $5 trillion. That's trillion with a T worth of value. USDC has quickly become one of the easiest ways to move your money around the globe. On top of all that, Circle is building products for companies and institutions that want to adopt this technology. That means payment transactions, fraud management tools, digital asset custody, and a whole other suite of services. Here's one of my other favorite parts about Circle. They post monthly audits of their reserves, which means that I don't have to trust. I can verify that my money is safe, transparent, in a compliant manner. Helps me sleep easy at night, you know? As a seamless, trusted digital dollar, USDC is a 0-to-1 opportunity for the entire global financial system. And you know what? Don't trust me, you can verify. Check out their recently published Transparency Hub on the website. It's a great update to Circle's content in USDC, outlines everything from USDC weekly reserve reports, monthly attestations, and blog posts written by their exec team. Just go to circle.com/transparency to access it. Now, back to the show. Maybe we can speculate a little bit here on the back of the interview that Juliet gave, and just let's ask ourselves, let's continue, let's take your and my minds to December of this past year, right? And let's look at a couple of the trends that we've talked about on this podcast, but also that Juliet kind of lays out in this chart here. So inflation peaked in the US back in June of this year. We had a 9.1% headline CPI handle. Currently, we're at 8.3. Nobody liked the last August's data for CPI because everyone was very concerned that it was 8.3 instead of the 8.1 that we were expecting. But as the White House has pointed out, to much mocking, right, on the internet, the pace has certainly slowed, right? They are right in saying that the pace has slowed. Seems a little stupid of them to die on the hill of technicalities, which is how it comes off, but they are correct that inflation has decelerated, certainly. So let's play ourselves out, and then let's pull two more trends out that we already know are kind of in the work. Let's look at housing and let's look at unemployment, right? So let's say it's December of this year and these trends continue on the current trajectory that they're on. Let's say inflation has fallen down to, let's say headline CPI is somewhere around 6.5%, right? Let's say it keeps on this kind of trajectory that it's currently on. Let's say the housing market has turned, right? And these rising mortgage rates has finally, it's starting to play out in the price of homes, and we're stopping to see these like crazy lines of people that are waiting to buy, housing at sight unseen, 20% increases over the asking price. And instead housing prices have started to decline. And let's say the current unemployment rate, which is around 3.7%, let's say that jumps to about 4.5%. And let's say the stock market is off 10 to 15% from what it is right now. In that environment, I think you get and those are all like very realistic things to happen on the current hiking cycle. And then say the Fed is hiked, from the, they've gotten it from Fed funds expectations from 4%. Let's say it's not two more 75 basis points, but let's say it's two more 50% basis points. I don't know. I think in that world, investors will pretty clearly say, hey, maybe we have gotten inflation under control. Maybe we have taken enough pain as the economy really needs to see. And then you start looking for upward type momentum, right? And if all of those things happen, right? If basically all of the indicators that we look at for the health of an economy started to move in the other direction, the way I just described, basically what you're describing is a reversion to the mean, in terms of those, that would bring unemployment up to somewhere where it's pretty healthy. 4.5 was the theorized, that was full employment, right? For a long period of time. We are more employed than economists thought was even possible before. That's sub 4.5%. So I don't know. I know it's really bearish out there, but I actually can see a world where basically if the trends just continue to play out over the next couple months on the current trajectory that they're already playing out, we're kind of setting the stage for, maybe it's, chopping sideways, or it could even be a reversal in narratives, and the Fed can say, hey, maybe we've done our job. I don't know. What do you think?
So it's an interesting case, compelling case that you make. I would agree with you if we move the argument away from risk assets, like let's just say stocks. And so instead of saying stocks are going to do okay, they might sell off 10%, but they're a they're buy at these levels. If instead of saying that, you said what is kind of an inverse or converse, whatever, which is that short-term interest rates have peaked. We're close to 4% on the 2-year Treasury note. That's going to be the top, and the 4.5 Fed funds rate, that's the terminal rate. That's going to be the top. We're not getting to Zoltan's 6% scenario. If you said that, I would agree with you, and I'd say the odds of that are probably greater than 50%. I would agree with you. I feel like with risk assets, there's so much volatility, and I'd also say that you could make the argument that particularly stocks have fared better than they quote should have. Should is doing a lot of work there. Dangerous word, but given the rise in risk-free rates, the equity risk premia, this is a volatile world. The VIX is at 25, which is not that high, and equity risk premia, sort of the discount that stock investors demand from stocks, given that risk-free interest rates, 10-year Treasury note, 2-year Treasury bill, whatever, is so much higher. Let me, if the S&P 500, let's say it has a PE of 25, let's just say a PE of 20. That is basically like a 5% earnings yield, right? Because it's just you divide 100 by 20. Well, the 2-year now yields 4%, and the 2-year Treasury is a guaranteed thing, whereas the S&P 500, you're buying something that's quoted mark to market daily. It could crash 50% in a few months. Obviously that's not my base case. Now the S&P 500 will grow its earnings, whereas the 10-year Treasury note, 30-year Treasury will definitely not grow its earnings. It's a fixed income, emphasis on the word fixed. But yeah, I could make the case that stocks in particular could go a lot lower, even as risk-free interest rates remain high, or even as risk-free interest rates don't increase further, I should say. What do you think about that?
I think that makes a lot of sense. I think that makes an enormous amount of sense. One other thing that I'd love to get your take on, and that I hadn't really thought about, but really, Juliet's interview here is really carrying our interview. But she made a great point about this idea of financial repression and productive versus financial risk taking in the stock market. And she kind of made the point where if you have higher interest rates, and that drives down the expectation for stock appreciation, then what it might actually do is limit buybacks for companies in general. So, and Yuri and Timur made this point on the panel that you did at this last DAS, right? So he kind of said basically everything that you've seen in the stock market so far, there are two components to pricing in stocks, which is valuation, right? So what is the value that they're getting on earnings, and then the level of earnings themselves. And so far, primarily what we've just seen is a reversion in terms of valuation. But if the expectation moving forward is that stocks are not going to just continue to appreciate, and the hurdle rate on capital, which is set by kind of basically the interest rate in the US, is going up, then suddenly it doesn't make sense anymore for companies to buy back their own stock. And instead, what you could see is a much healthier trend, at least in my opinion, of reinvesting the capital that they're earning, not just in buying stocks, which would kind of be that financial risk taking component, and instead investing in new products on the margin. Does that argument make sense? I heard it laid out and I was like, I hadn't really thought about it like that, but that does make a lot of sense, right? You bring up the hurdle rate on new investments in the company, you bring down the return expectation on stocks. Suddenly the math doesn't work anymore to just run buybacks into infinity. And what you actually might get is investment in actual R&D and products in the S&P, which would be pretty cool.
I completely agree. Andy Constant made that point about quantitative easing, that part of the reason quantitative easing is so effective at boosting asset prices in the US as opposed to Japan or Europe is that the stock market, the US has a very buyback culture. And yes, it makes sense. A lot of people think that, Boeing, they're buying back stock with the money that they made from selling planes. And yes, that's true. But if their debt is also increasing, you could also say they're buying back stock with money that they borrowed from investors. So if they, they're borrowing at 5% and that's their cost of debt and their cost of equity, which is a term that is very confusing definitely to me as well as perhaps some other people, is, let's say 6%. It actually is, I guess, a good transformation. But if you suddenly have to borrow at 10%, buying back your stock becomes a lot less appealing. So I think you're absolutely right. And this goes to just the the sort of business models that have become very popular in the U.S. over the past, let's say, 13 years in Silicon Valley, where instead of you and I launching a cab company and we start off 2 employees, 2 co-founders, and we drive the taxis, and then we use the money that we make to hire more people, and then we use that money to hire more people. Instead of that, like, we just get a check for $50 million, and it's like, screw taxis. Taxis are so 20th century. It's about networks. It's about transportation. It's about the fleet of the future. And we're just losing, billions of billions of billions of dollars after every year. And actually, people who invest with us, they make money because every single round is marked higher and higher and higher. Yeah, I think we could be coming to an end, not an end, but uh, the end of the peak of that in terms of like rate of change, if that makes sense.
Do you see Stan Druckenmiller said we might basically be range bound in terms of stocks for the next 10 years in the US? Now, who knows, right? I'm sure the caveat, that was the headline. I'm sure the caveat he gave is this is an investment advice and I'm not sure, yada, yada. I'm liable to change my mind in the next 24 hours or as soon as I see a piece of data which disproves what I just said. But he said there's a decent possibility of that happening. What do you think? What do you think that would produce in an environment? I think you could again make the case that might not be such a bad thing. That's basically because stocks, they can revert in terms of price or they can revert in terms of time, and maybe time wouldn't be such a bad way to revert.
Yeah, in other words, the capital market appreciation of stocks over the past decade has just priced in the next decade. So by not changing and staying at current levels, everything would mean revert. Yeah, that's compelling. I would say that for literally the past 40 years, anyone saying the next 10 years for stocks is going to be flat, their track record was very poor. There's no investor on the planet Earth who I have more respect than Stanley Druckenmiller, but I think he would admit that what I said is true. Is that it's been a very bad prediction to make for the past 40 years. Yes, it could become true, but as you said, he's a macro investor who changes his mind very frequently. Yeah, in other words, in 2 years ago, it probably was a good thing to buy extremely speculative, unprofitable technology companies, and now it's not. You got to change your mind. So in 2 years, Stan Druckenmiller could be buying an incredibly large amount of stocks because he changed his mind, but someone listening to that still is like, oh, but Stan said this, and then they miss out on 8 years of gains. So it's important to point that out. But yeah, tons of respect for Stanley. He's a legend. Mike, do we have time for me to quickly go through this table at the last thing for the FOMC?
Let me pull it back up here.
So yes, I'm extremely confident, very confident, Mike. Cannot say how confident I am that it's going to be 75 basis points. And thus that would say, oh, so risk assets rally. Should we buy calls on S&P 500? Should we buy calls on Ethereum? That is a plausible thing based on what I said. However, what could Powell do or say that would be hawkish so that risk assets perform poorly on Wednesday, even if it's going to be 75 basis points? Well, I was thinking about this today. I think it's tough for Powell to say something in terms of narrative, in terms of metaphor, in terms of language, in terms of vibe that is more hawkish than Jackson Hole. Yes, it's possible, but how much can you talk about how much you like Paul Volcker? It's like QE, where once you do so much, doing twice as much is not going to have that much. There's what's it called? When it returns, effect. Not returns, when it's like the more you do,
diminishing returns.
Diminishing returns. Thank you. It's diminishing returns. All right. But what could he actually say? He could commit to, QT for the next 4 years, regardless of if the Earth gets hit by an asteroid. He could say that. He could commit so that he could commit on balance sheet. He could commit on interest rates. He could say we are not cutting. We're not cutting unless an asteroid hits the Earth or something like that. But we are extremely firmly committed. And yeah, in which case you would see the 2023, after April futures sell off and interest rates would rise, which would be pretty bearish for the market. Another thing, the final thing that I think mattered, not one of the final things that I'm looking at, is the summary of economic projections, which did not come out in the July FOMC meeting, but did come out in June. So what we're looking at here is the forecast of the FOMC for core PCE. They don't look at CPI, or what they track is PCE, not CPI for inflation. Core is minus food and energy. funny because food and energy is, of course, the most core thing of life, but that's what it is. So if these median core PCE projections for 2023 are going to be priced up away from 2.7 or from 2.5 to 3.5 on the range, that is something I will have my eye on. Obviously, 2022 will be marked up a little bit just because, but that's sort of already baked in the cake. So 2023 is sort of how the Fed is pricing. So if that's unchanged, I would say that's somewhat dovish. If it's higher, I would say that's somewhat hawkish.
Yeah. You know what? I like what you're doing here. I will also lay out, something else that would make me sort of change my mind. Not even that the scenario that I laid out was just the base case. I just think I'm actually starting to want to start a trend here. It's like be the man in the mirror, change the man. I'm just I feel like I've been under this deluge of just negative content. I just feel the need to just voice the fact, right, that things actually could be better than they appear if you solely consume Twitter and paid attention to the media. So that's why I like Juliet's explanation for how we could actually achieve a soft landing, right? But the other thing that I will say is the fly in the ointment, so to speak, is just more geopolitical strife, right? I mean, that was the thing that nobody really saw coming. I know some people saw it coming. Most people didn't see coming until it happened, right? Which was the whole Russia versus Ukraine crisis. It doesn't necessarily seem to me, operating with the caveat that I probably have 3% of the available information out there, that the US necessarily wants a quick end to this crisis, right? We continue to support supply munitions to Ukraine. Whether or not you think that's a morally good thing, we are supplying the munitions and seemingly drawing out the conflict, right? So it doesn't seem to my 5-year-old middle of the bell curve geopolitical brain that we are, it's in the interest of Washington to end the conflict quickly. I don't know that to be true, but the other thing that could happen is the thing that everyone's been talking about forever, which is Taiwan, basically. And every other, sort of conspiracy or whatever idea aside, I find it very hard to believe that, China's expressed interest in Taiwan, obviously reunification. I'm sure they're at least watching the Ukraine-Russia conflict play out and taking lessons from it in one regard or another. That doesn't mean they're going to do anything about it. Maybe they won't do anything for a long period of time. Maybe they'll never do anything, but I'm sure they're watching this conflict play out.
Definitely. Mike, I know you got to go. Can we do some quick plugs? We got to do the plugs. Okay.
Yeah,
so
do that.
Digital Asset Summit last week in New York, it was incredible. But if you missed out, don't worry. There's another one in London, 17th and 18th, is it?
Yes, sir.
All right,
yes, sir.
There we go. And I believe you can use the code guidance250, but this is on the margin. So Mike, what's your code that people can use?
We're doing Mike 250 again.
Mike 250.
So this is, you did win on leading up to DAS. So you got a very strong audience there that love you, Jack, and I'll always root for you. But in this instance, don't use guidance 250. Use Mike 250.
Yeah.
every other instance I'm supporting you, but competition, baby.
Yeah.
No, seriously, this is going to be great. We've been doing London for a number of years. Different, it is interesting to see because obviously there's a lot of continuity between New York as a financial hub, London as a financial hub, but there are different sectors that are important to London, different points of view represented over there, and just a really, really great, very strong community. So if you're in crypto, if you're in finance, and you want to get with a gathering of like-minded people, DAS London's a really good option.
Right. And Mike, we're very close to 100,000 followers on YouTube, and I was reading late last night how to get more subscribers, and it's to tease future content so people feel like they need to subscribe to miss out. So in that spirit, here are some guests who will be on Forward Guidance over the next month. Professor Evaluation, Aswath Damodaran. You ever wonder what equity risk premium means? How things are valued? He is the person to explain it. That will air shortly. Peter Crane, expert on money markets, with fan favorite Joseph Wang, will be coming on. Rory Johnson, commodity expert. Jacob Shapiro, geopolitical expert, which we're talking about Taiwan. George Noble, the man who worked with Peter Lynch. He is launching an ETF. He will be coming on hopefully soon to talk about that. Harris Kupperman is coming on. Jim Bianco. Let's see. Lynn Alden.
Love Jim.
Daniel DiMartino Booth. Folks, that's just Forward Guidance on the margin, boiler room, macro trading floor. It's unbelievable. So you got to subscribe. I don't want you to hit the subscribe button. I want you to smash it. Mike, let's and final word.
I'm not going to do any better than that. I'm not going to do any better than that, Jack. That was excellent. These are always fun. Forward marginal guidance. Big fan.
Sweet.
We get to do this together. So thanks for coming on the show, buddy. Talk to you soon.